Hello and good afternoon, everybody. Thank you very much for joining us at our Sydney Investor Day for 2019. I see many familiar faces here, but for those that don't know me, my name is Steve Bennett and I head up the direct property business at Charter Hall. As per usual, what we like to do at these things, we'd like to do two main purposes. We'd like to give you an update of the funds that many of you are already invested into. But first and foremost, we want to educate you. We want to give you updates on the market. We want to give you updates on key property trends so that you can make more informed decisions going forward and understand what I passionately believe is a fantastic investment class and that investors should consider more in their portfolios. The agenda today, just following that, I'm just going to give a very high-level overview on the direct business. I'm then going to pass over to David Harrison, the CEO and Managing Director of Charter Hall, to run through where the group is, where the manager is that manages these funds. And then we have Selena from Ernst & Young, who's a true property expert in terms of the trends that are happening, and she's going to run through how much data is driving the use and trends. And it's very important for groups like Charter Hall to listen to experts like this because it does influence the investment decisions, how we lease up assets, the kind of developments we do. And then you hear from David from Jones Lang, who'll give you an overview of the market. So he'll touch on what's happening in the office sector, the ever-booming industrial market, which, as I said last year, we thought was a very key sector. The thematic around that and e-commerce has only strengthened over the last 12 months. And then I'll provide an overview of the funds and then open it up to Q&A for any questions. This basically just says I can't give you financial advice. Everyone here is just providing information. The funds have been doing very well. I'm pleased to say that over a long period of time, the Charter Hall Direct suite of funds, when Cedric was first in the business, through to Richard managing it, and now myself, has continued to perform for investors over a long period of time. So the grey section there is our closed for investment, funds that we've raised money for, managed, and since returned the capital. The closed funds are funds which we're still managing the assets on your behalf and paying you regular, either monthly or quarterly distributions, but are no longer open for investment. And the ones on the far left side are still open for investment. And what we've done over the last few years at Charter Hall is we've moved the business model to open-ended funds, which are available for investors whenever it suits you. And we've introduced what we term just rolling 5-year liquidity events. So we've done that because we know the feedback from most investors when we hit these review dates is, well, how do I stay invested? So we're making it an absolute choice for investors on that front. The direct team, it's a relatively small team in the 550 odd people that are in Charter Hall, but it's a team I'm very proud to be associated with. We've been together for a long period of time. We've won some fantastic external awards from external research houses. And I don't put that up to say what a great job I'm doing. It's really a reflection of the direct team and the wider Charter Hall Group's contribution to these funds. And ultimately, we're getting these rewards because they're recognising the results that we've been able to deliver for the investors in these funds. So without any further ado, I will introduce David Harrison, the Managing Director and CEO of Charter Hall. David is a fantastic property expert. I've worked with many people internally at Charter Hall and Macquarie Bank and through numerous external companies as well. And what I can say sets David apart from the other people and why, in my view, he's the best in the market is he does two things exceptionally well. He builds fantastic relationships. And property, I was saying to some people earlier, is a relationship game. So he builds those relationships with key stakeholders, being the tenants, so delivering win-win scenarios, helping them achieve what they need for their use, and the investor customers. And then secondly, he's able to match the right property investment opportunity to the right equity source. So most of the investors in this room are invested in the unlisted funds. We purposely make those lower risk, so longer term leases, high occupancy, secure income streams, and matching the right property investment to the equity source is critical to what we do at Charter Hall. So please do welcome to the stage David Harrison, who will give an overview of the group.
Thanks, Steve.
Look, just a couple of sort of comments to start with. First of all, you're here being hosted by a property company. We're not a subsidiary of a bank or an insurance company or of a multinational. We're an Australian property company. And we're very proud of the fact that it's in our DNA from the foundation of Charter Hall that we're there as property specialists to deliver stable dividends to our investors, whether it's those of you in the room, in the high net worth self-managed super funded sector, through to the biggest super funds in this country or the biggest global pension funds and sovereign companies, sovereign wealth funds and insurance companies in the world. Likewise, we're a listed group. We also manage 3 other listed REITs, or those of you around as long as I, they used to be called listed property trusts or LPTs. And in all of those property portfolios, while Steve mentioned there's a relatively small group in the direct business, there's a very big group within the 550 people in Charter Hall that are actually doing the property management, the leasing, the development, the acquisitions, the divestments, all of which go to being able to produce the sort of property returns that we've been able to deliver in the past as per Steve's performance track record graph. The other thing I would say is I get asked all the time, where are we in the cycle? Welcome, Cedric. It's unusual for you to be late. It's something I taught you many years ago. I'll just address 2 or 3 things. I'll give you a bit of a briefing on Charter Hall, where we are in the cycle and why I'm putting my money where my mouth is in terms of continuing to invest in both our unlisted property funds and our listed REITs, because I think when I look at term deposits, I look at the world where we sit at the moment, long-term leased commercial property is producing a pretty good risk-adjusted relative return versus a lot of alternatives. And I think that's going to continue for quite some time. It's going to be a continued theme that Charter Hall Group has been promoting for some years, the lower for longer inflation and interest rate environment. And really what we want to do is take advantage of that to provide, as I said earlier, stable, capital protected returns for our investors. I don't look too much about cap rates going up and down. Ultimately, over the long term, I'm more interested in seeing the dividend yield being protected and growing a little bit every year, so that our investors, whether they're large or small, are getting an income growth profile that is better than what you get in the bank, and certainly it hasn't got absolute capital protection like a term deposit. But I think, as you saw from the track record, we've done a reasonably good job, I think, of protecting people's capital and providing some growth. So I'll just give you a bit of a rundown on Charter Hall Group. It might surprise many of you in the room, but we are the largest manager of external equity in this country. We're the second largest owner of real estate in this country after Westfield, which has got a different name now called Centre. So just over $30 billion. These FUM numbers are always a little bit behind the times because we're growing at a fairly rapid rate every quarter. Just over $30 billion in assets, split between high-quality commercial office assets, high-quality industrial logistics. I'll talk a little bit about what is a long-term trend that's going to drive logistics and industrial demand and produce what we think will be good risk-adjusted and stable growth in the industrial sector. We split our retail into 2 categories. There's shopping centre retail, which you're all familiar with. We are right at the other end of the spectrum to Westfield. We're a convenience-based shopping centre owner, high proportion of income coming from your supermarkets, your Coles, your Woolies, some Audis, but 70 to 80% coming from food and food services, and less than 5% of our income in those shopping centres is generated from fashion and apparel. So it's a very big distinguishing feature between what I call our non-discretionary shopping centres or retail shopping centres versus the discretionary end. The other thing that we've done a good job of over the last 10 years is really carving out a niche as being specialists in long WALE retail. Now that, for any of you that don't understand acronyms, and the property industry is full of acronyms, WALE stands for weighted average lease term to expiry. So another way to put it is, what is my average lease term left before the leases expire? We have a very high retention rate, so when you think about lease terms, there's generally always options, and we're running at about 85% retention rate. So what that means is, on average, 85% of our tenants are renewing at the end of their leases. So long WALE retail, what does that mean? I'll be amazed if anyone in this room hasn't been to a Bunnings store. Whether you live in the country, where I grew up, or whether you live in the city, everyone knows Bunnings. We're now the second largest, after Wesfarmers owned Bunnings Warehouse Trust, owner of Bunnings assets in this country at nearly 1.8 billion. It's one of the best retail businesses I've seen in the world. It generates an EBIT margin of about 12 or 13%, 4 times the profit margin that Woolworths and Coles make in their supermarkets. So it's a very resilient business, and it's literally got a monopoly in this country after the sort of failed attempt from Lowe's and Woolies to do Masters. So that's a big growth engine for us, and we think that's very resilient. The other thing that we have in long WALE retail is a large portfolio, nearly 1.5 billion of pubs and Dan Murphy's assets leased to the market leader in the Woolworths owned, or 75% owned, ALH Group. We get 20-year triple net leases. They do all the maintenance and any structural repairs and maintenance, and they pay us a growing rental income with annual CPI adjustments. The other little green element of that $30-odd billion is a category that we now call social infrastructure. Last year we took over a property company called Folkestone. They're the largest owner of childcare centres in this country through a listed REIT, which is now called the Charter Hall Education Trust. The majority of its assets are long-term leases to childcare tenants, from not-for-profits like Good Start through to people like G8 that you would have heard about, the listed group. But the other thing that portfolio is doing is moving into other forms of social infrastructure. So just this week on Monday, we announced the acquisition of a $100 million asset in Brisbane, which was bought by 2 of our listed REITs, and it's the northern bus terminal for Brisbane City Council. Unlike here in Sydney, where we've got 32 odd councils, there's only 2 big councils in southeast Queensland. There's Brisbane City Council and Gold Coast City Council. So they run their bus network, and Brisbane City Council, which is essentially government, has given us has got a 20-year triple net lease on that. So that sums up, if you like, the sector diversification in the group. The other thing that's important is the statistics at the top of that slide. 820 properties, over 3,000 tenant customers, nearly $2 billion in rent we collect each year. And importantly, as I said earlier around WALE, our average lease term, or WALE, across our 30-odd billion is 8 years. Now, by sector standards, that's more than 50% of the average across all of the other major portfolio owners in this country. Importantly, occupancy, 98.1%. I tell my operations team that's 1.9% of occupancy that you need to fill, because the opposite of that is 1.9% vacancy. So we're constantly trying to improve that occupancy, but it's been at that 98% level for many years, so we're pretty comfortable about our ability to do that. And that last statistic there is a cap rate. For those of you that don't understand the property lingo as much as others, it's basically your initial yield. So if you think about a property and it's $100 million and the tenant's paying me $6 million a year in net income, I'm getting a 6% yield or 6% cap rate. Those cap rates move around a bit in the last few years as interest rates have come down. They've come down. But the point I would make is today, the all-up cost of debt for us to borrow 5-year money is a bit over 3%. When we have got initial yields or cap rates at 5.5% to 6%, it's one of the highest spreads to the cost of debt I've seen. Now, we all know debt can go up and it can go down. Obviously, the Reserve Bank's just dropped interest rates a little bit to another record low. But I always sort of look at the spread of that cost of debt to the cap rate. But I also look at the spread of bond yields to what we call an internal rate of return, which is really just adding to the yield the expected rental growth and hence capital growth to get to an unlevered property IRR or a total return. Across our 30-odd billion, we're just under about 7% as a total return. So if you think about 7% and 10-year bond yields at 1.7% or 1.6%, that's an incredibly large spread. Now, I'm here to tell you that spread will move around a bit. Bond yields could go down, they could go up, so the spread narrows. But through the cycles, that spread of property IRR to 10-year bond yields has been around 375 or 400 basis points. So at the moment, it's at one of its widest spreads. What does that mean? It means that there is some buffer that if bond yields go up, you're not sitting at a record low spread. You're actually sitting at close to a sort of record high spread. So you've got the ability for interest rates to go up without it having a massive impact on sort of property prices. The other thing that I'd just say is, we've had, whichever side of politics you're on, it doesn't matter. The Morrison government being re-elected has re-injected confidence into the economy. Businesses, and I'm talking to over 3,000 tenants regularly, are more confident. We've also got the dark cloud of potential taxes on negative gearing, capital gains tax, dividend imputation have been lifted. So the business and the consumer is far more confident after the re-election of the Morrison government than they were. And you're seeing that with a resurrection in confidence and even in the residential market. So I'm pretty, apolitical, but they are the facts. This economy has got more confidence than it had a month ago. Yes, the Reserve Bank's dropping interest rates for a reason. We've got anemic wages growth. We've got slow inflation. They need to try to do the work that I would argue fiscal policy hasn't been doing in a procession of governments in this country for some time. But I do think the cocktail of, the removal of this worry about new taxes, a little more consumer confidence, and obviously the Reserve Bank dropping rates is going to help continue to see more business expenditure come in, business confidence improve, and hopefully, I was just saying earlier, we're seeing really early signs in our shopping centres of sales starting to improve, which is really what the Reserve Bank's trying to do. They've only given me 2 slides, and that's usually a reason to sort of limit my time to sort of 10 minutes or 15 minutes. This is just another explanation of what I call the market penetration of Charter Hall throughout this country. We're a big country, so these graphs trying to get on one slide are always difficult, but you can see, with $12 billion in New South Wales, predominantly Sydney and Sydney metropolitan regions, $6 billion in Queensland, another $6.5 billion in Victoria, predominantly in Melbourne. We've got $300 million in Tassie. I know Cedric's a big fan of Tasmania as a food bowl, as we are, and we've got some really strong long-term leased assets there to government and people like Woolworths for a distribution centre. And then obviously $1 billion in South Australia and about $3 billion in Perth. You can see that we're quite diversified. Unlike many of our competitors, we have full service offices in each of those capital cities. We've got people on the ground in Perth and in Adelaide and in Brisbane and Melbourne that give us both local insight, but then our centralised teams are able to utilise those local resources to implement our strategies. And finally, for me, what we call our Charter Hall Direct business, which is the business that Steve runs, at $4.5 billion of assets. It's an important part of the business. As I said, myself, many of our Charter Hall directors, and certainly the directors on the direct board, invest in many of the funds that you invest in as well. So we've got high conviction for what the team are doing. It's an important part of our business. We'll continue to put more balance sheet investment into the direct business. And lastly for me, thank you for your custom. We're very keen to ensure that our investors at any level, whether they're the large super funds or retail investors, high net worth, self-managed super, feel they're getting the same service, whether you're a $150 billion super fund or whether you're a $50,000 investor. And what I say to my team all the time is, every one of the investors out there, whether it's in our direct business or in the listed REITs, and we have nearly 30,000 retail investors across everything, every one of them is it could be your mother, your father, your uncle, your cousin. At the end of the day, think about it as if it's your money, because you've got a fiduciary duty to invest and protect the capital of others. And it's a really important, I think, cultural aspect of Charter Hall, because we are a property company, that we've been able to espouse, and I think the whole team have embraced that. So that's enough for me. Thank you. I would love to stay for lunch. Unfortunately, we are doing an equity raising in our diversified long WALE REIT today, and you'll all have an opportunity through the UPP to invest in that over the next few weeks, and hopefully by the time you have to make a decision, that the share price is a lot more than what you'll be having to pay under the UPP. So thanks very much for your support, and have a good day.
Thank you for that, David. It's always good to hear from the CEO to give investors a bit of an overview that's a bit broader than the unlisted funds that I manage, and I guess what sets the group apart from some of the other property players in this space. I'd like to introduce David Rees to the stage from Jones Lang LaSalle. David is the Regional Director of Research at JLL, based in the Sydney office. He's responsible for the coordination of market forecasting and the strategic portfolio service across the whole of the Asia-Pacific region. David's previous roles include Chief Equity Strategist at BT and Head of Research at Commonwealth Bank, responsible for coordinating the bank's research activities across credit, FX, commodities, equities and real estate markets. David holds a PhD in economics and an MA in statistics. He's a Fellow of the Australian Property Institute and a member of the Royal Institute of Chartered Surveyors. So please welcome to the stage David, who will give an update on the Australian real estate market.
Sorry? Thank you, Steve, and thank you all for the opportunity to speak to you. I suppose you might describe this as the low-tech part of the proceedings. What I'm going to be talking about is essentially direct property markets. And if you think back to what David Harrison had to say about the portfolios to which you're all exposed, you've got about 48% of your capital in the office markets. You've got about 25% in retail, 25% in industrial. Then there's a small chunk of social infrastructure, which I'll talk about, which is I think quite important actually, which I'll talk about in a few minutes. Now let me see if I can progress this. Right. What I want to do is, first of all, just talk about some of the macroeconomic backdrop, and then I'll talk about some of the sector profiles, office, industrial, retail primarily. And then I do want to finish with a few conundrums, because As David mentioned in his introduction, interest rates have been falling. They've been falling for a long time. Interest rates are a very important driver of capital values and investment performance. So that's one of the conundrums that I think we need to think about, and there are a few others. In terms of, from the macroeconomic point of view, I want to talk briefly about employment, about construction, and about cross-border trade. Clearly, one of the drivers, particularly of retail, but in fact of a lot of other aspects of the economy as well, is wages. And we know that wages growth has been low. The chart that you have on the left there shows you wages growth going back to 1998. Wages used to grow at 3 to 4%. As you can see, they've come down. They're now growing at around about 2%. There's no great surprise there. Wages tend to grow at the rate of inflation plus productivity. And inflation is low, 1.3%, and productivity growth has been low recently. So this is what you'd expect. But the trade-off, if you like, the positive trade-off from low wages is the fact that employment growth has been very strong. And the chart on the right shows you growth in employment in the different sectors. And that's important because different sectors clearly have a very different profile in terms of employment growth. If you look at the chart on the left, on the right there, mining, for example, employment's been falling. No great surprise there because the big mining boom has been winding down. If you look on the extreme right, manufacturing, employment has been falling. But retail and wholesale trade looks respectable. Construction has been growing fast, and no great surprise there, the residential market. On the right, business services. Now that's important. White-collar demand for underlying demand for office markets has been growing strongly. But the big sector, the growth where employment growth has been particularly strong, remarkably strong, is in fact household services. That's escalated dramatically. What is household services? Health, education, recreation, hospitality. That sector, a lot of people think Australia is basically a big mining operation, especially offshore investors. They think they're investing in the mining sector when they come to Australia. Don't you believe it? The biggest sector in Australia is the services sector, and there's a lot of white-collar employment there. But think back to that small component in your portfolios of social infrastructure, health, education, childcare, recreation. That is the big growth sector and has been the big growth sector for the last few years. The second macroeconomic trend which is important for real estate is what's happening to infrastructure. Some of you might have walked up George Street at some stage in the last 18 months to 2 years, and you will notice that George Street is basically a building site. The chart on the left shows you the big boom in infrastructure which is happening right now and is going to continue to happen through 2020, 2021, on into 2022. Australia has never seen an infrastructure boom like this. And if you are interested in George Street, you'll see, let me see if this thing works there. There is the Sydney CBD light rail. That little sliver there, these are the other major infrastructure projects that are coming down the track. Why does it matter for real estate? Well, it matters because, first of all, because it stimulates the economy in a general sense. There's a demand, underlying demand for labour there, but it matters from a locational perspective. The pie chart on the right shows you where, on a state basis, where the infrastructure is occurring. New South Wales accounts for about 40% of it. New South Wales punching well above its weight, and there's Victoria. So the two of them together account for about 2/3 of that. Every infrastructure project has an impact, usually positive, but sometimes negative, on some real estate investment. A big new highway might take shoppers away from your shopping centre to another shopping centre. That could be a negative impact. It could have a positive impact as well. Any investment that you make in real estate, I think now has to think very carefully about what the potential impacts are for the infrastructure which is going on around us, and nowhere more importantly than in New South Wales. So infrastructure is winners, but also losers. And the third macro chart I'm going to show you is cross-border trade. This is from data from the International Monetary Fund, and it shows forecasts for different countries. These are export forecasts from 1990 to 20, so the next 4 years, okay? Exports of goods, and that's imports of goods. That's physical imports. So exports is tons of coal, tons of iron ore, and imports is number of containers being offloaded in Sydney or Melbourne. The reason I'm showing you this chart is because I think it's quite remarkable. These are the countries with strong import and export growth. India, Indonesia, no great surprise. There's Australia. Down here, here's the UK, Japan, Russia, Canada. What you're looking at here are big drivers for the industrial sector. There's a high correlation between container traffic and the demand for industrial land and the demand for industrial space. And if this chart is correct, what this says is that over the next few years, you're going to be operating in an environment where there's a big demand for logistics in particular. So those are just some of the important, I think, high-level macro trends which should drive our thinking when we're thinking about particular real estate investment opportunities or particular sectors. Secondly, let's look briefly at the office market, the retail sector, and the industrial sector. And when I think about the office market, I'd say office market, your key word is diversity. When you think about retail, I think the key word is repositioning. And if you remember, David Harrison talked about non-discretionary spending and the importance of that in retail performance. We'll come to that in a minute. And the third sector is industrial. And I think the key word for the industrial sector is re-rating. Before we look at the individual sectors, let's just look at the big picture. This chart shows you offshore investment coming into real estate in Australia. It starts in 1990. The red columns show you offshore investors coming into Australia. And the grey columns down at the bottom here show you offshore investors taking capital out of Australia. So it's a two-way street. If you go back to 1990, you can see for about the first 5 or 6 years, it was predominantly an inflow of capital coming in. In the early 90s, capital came into Australia to buy assets. We had a recession, if you remember, and things were being sold off quite cheap. A lot of that capital was actually Japanese capital. They bought Chifley Square, for example, over that period. And then from the mid-90s, for about the next 10 years, you can see that the inflow slowed down and there was a net outflow. Over that period, offshore investors bailed out of Australia. We bought back the farm. We bought back our own assets from offshore investors. Over that period as well, Australians went offshore to invest themselves, enthusiastically but not always wisely. And a lot of capital went offshore to invest in the United States or in Germany. Some of you may remember that some of the funds or the REITs you invested in became enthusiastic international investors, which didn't end well in 2007. And then, from 2008 onwards, the last 10 years, what you see, those red columns, is a huge inflow of capital coming in to buy Australian assets. And that's been an important part of the story. In fact, the black line is the proportion of transactions accounted for by offshore investors. And if you go back to 2004, offshore investors accounted for about, 4 or 5% of transactions. Now, in the recent years, they've accounted for about 40%. Of all transactions in Australia, about 40% have been accounted for by offshore investors. But that's only part of the story. The Reserve Bank is concerned about this offshore capital coming into Australia and pushing up values because of this, pumping up asset values in Australia. But look at this part of the column as well. This is offshore investors selling out. 2018 was a record year for offshore divestments. That capital flow is a two-way street. It's not just money coming in and pumping up values. Offshore investors have made money, they're taking capital off the table. I think that's quite healthy. That's what you want in a market. You want to see capital flowing both ways. And this 40%, which looks very high, if you look at the international picture and say what's happening globally in terms of offshore investment, that 40% is about ballpark. It's about par for the course. Globally, across the big global markets, Europe, UK, Japan, US, offshore investment accounts, as it does in Australia, for about 40%. In the last 10 years, real estate has become, for the first time, a genuinely global asset class. We used to be small and parochial, but it's now a global asset class, and that's good for the market. But just be aware of the fact that if you're thinking about real estate in Australia, you can't just focus on the domestic economy. Increasingly, we are part of a much bigger picture. Office markets. This chart shows you vacancy rates across the major office markets in Australia. And here, the red columns are prime grade. That's what sort of matters for us. That's the market we're in, or what the Charter Hall is in. Look at the prime grade vacancy. The grey is total. That's prime and secondary. Here's the lowest markets. The lowest vacancy in any market in Australia is Parramatta. Prime grade vacancy is just about nothing. There's Melbourne. Here's Sydney, Nor West, Sydney Fringe, Chatswood, Melbourne Fringe. At the bottom, at that side, you've got Perth. Perth market vacancy going up into the 15, 16, 17%. There's Brisbane CBD, Adelaide CBD. On the left-hand side, these low vacancy markets are predominantly New South Wales markets. The dotted line is what we used to think, or perhaps we still do, is the sort of equilibrium. 7.5%, 8%, that's your sort of equilibrium vacancy rate over time in Australia. And what you can see is those office markets really are very tight, office in general, very tight from a vacancy point of view. If you look specifically at the big markets, the big liquid markets, the CBD markets, currently Sydney has a vacancy rate of 3.7%. That's almost an all-time record. It was lower in 1989, but it's pretty close to an all-time record low. Melbourne, 3.7%, much the same. Brisbane, 12, Adelaide, 13. Perth is the big vacancy market, 20%, Canberra, 10. And these are our forecasts. Forecasts are not always right, but I like to think our forecasts are better than most. Forecasts going out for the next 3 years. In 3 years' time, Sydney will have a vacancy rate of 5%, still very tight. Melbourne, 5.9. These will be still double-digit vacancy markets. What does that tell you about the future? What does that tell you about the strategy? In office markets, what you have to worry about is what's happening on the supply side. Don't worry about the demand. Demand moves around, but it's a secondary player. Even in the big recession of 91, 92, underlying demand for space in the Sydney CBD hardly moved at all, 1 or 2%. It's the supply that matters. And this shows you the supply profile across the major markets in Australia. This is what's under construction, okay, as a percentage of total stock, development pipeline as a percentage of total stock. There's Parramatta. We know Parramatta's got a very low vacancy rate. It's got a lot of construction coming down the track. The size of the balloon is the size of the pipeline, the square meters, okay, of the pipeline. Here's Sydney CBD. There's a big balloon there, but it's got a low vacancy, which is why vacancy is going to rise, but only to about 5%. Here's Perth. Very high vacancy, but very low development pipeline. That's what you want, isn't it? You want construction to be in those markets where vacancy is low, and you want low construction to be in markets where vacancy is high. And what you don't see in the chart is one of the most important aspects about office markets in Australia, and that is that to get finance, to get your construction out of the ground, to get those cranes up on the skyline, you need, in general, to have a high level of pre-commitment from tenants. And in general, Australian markets, which distinguishes them from a lot of markets around the region, so a lot of the Asian markets, we tend to have a high level of pre-commitment. So the supply pipeline is disciplined and the level of pre-commitment is quite high. When you've got markets like this with double-digit vacancy and single-digit vacancy and so on, it implies that the current profile is diverse and the future is also going to be diverse. So what does it imply about investment strategy? Well, since the markets are so different from 20% vacancy to 3.7, it means that from an investment point of view, if you simply sit on your hands, you're likely to have a very average kind of experience. It implies you need to think proactively and strategically and cyclically about your investment strategy. This shows you what's happened to rents, gross effective rents, which is probably your best measure of underlying demand. From 2013 to where we are now, the red line is Sydney, the blue line is Perth, Brisbane is the purple line. Sydney rents in the last, since 2013, have risen by 75%. They're all indexed to 100, by the way. So Sydney rents have been amongst the highest growth in the world, actually. And Brisbane rents have been very high. Perth rents have gone negative. Perth rents have fallen by about 40% over the last few years. Dramatically different performances. And that's the forecast. They all look sort of kind of, there's not much of a story in the forecasts. But if you take that data, instead of indexing it to 2013, if you index it to now, make that 100 now, that's where we are now, and say what happens in the future, then the blue line there is going to grow by 25-30%. That's Perth. The red line is Sydney, and that is pretty flat. So although Sydney has been the big performer over the last few years, given that vacancy is now troughed out, over the next few years, again, if these forecasts are correct, then it implies that your strong growth comes from Perth and then to a lesser extent Brisbane and Adelaide. So it says that over the next few years, you should be, whatever your game plan has been, you probably need to think carefully about your game plan in the future. Now that's office rents. This chart shows you retail rents. We know that retail is the sector that's been under pressure. This chart shows you retail rental growth from 2008. Sydney, Melbourne, Sydney is red, Melbourne is black. You can see in 2008, just when the GFC sort of started coming down the track, rental growth was around about 4 to 5%. Things were pretty good in retail. You can see how it's fallen, and really now for the last 3 or 4 or 5 years, rental growth has been approximately zero, or very close to zero. This is the sector that's under pressure. This is the sector where a lot of restructuring is going on. This is the sector where you have to adapt or adopt to meet the changing environments in which you're operating. But the trade-off from low rental growth is that vacancy rates, and these are vacancy rates across CBD, regional, sub-regional, that's all retail, vacancy rates around about 3.5%. When you walk around a shopping centre, you don't see much vacant space. That's what it says. So although rental growth has been very low, the trade-off has been that those shopping centres still have tenants, they're still paying rent, although this shows you some of the incentives that shopping centre owners have to offer in order to get tenants to locate there and to stay there. And this goes from 2015 onwards. The red shows you the proportion of tenants who want a 20% or more rent-free incentive to sign a lease. And what you can see, again, signs of a sector which has been under pressure, is that the proportion of those tenants demanding incentives, requiring incentives as part of the deal, has been increasing. One of the positives for the retail sector is that we've had a boom in construction, as we have in other sectors as well. And this shows you retail completions, construction completions going back to 1994. So you can see that it's been running at quite a high level over the next few years, there's going to be much less retail construction, so the supply of retail space is going to be less, which is a positive. Should be supportive, at least, of underlying demand for space and retail. Two reasons why the retail sector is under pressure, two key reasons. One is, as we saw at the beginning, wages growth has been low. People are paying back their credit card. Credit card growth is the lowest it's been for 8 years at the moment. So as consumers, we're very conservative. So the demand for retail spending has been very low. And the second reason, of course, is IT, the impact of technology. Shopping online instead of shopping physically at shopping centres. This shows you the e-commerce penetration in different countries. There's China, going up towards 25% on these numbers. 25 cents in every dollar in China, every retail dollar in China is spent online. The blue line is Australia, 2012, sorry, it was about 6. It's gone up to about 9 cents. For those here in Australia, of every retail dollar, about 9 cents is spent online in e-commerce. It's growing, but it's growing quite slowly. We seem to be about 10 years behind the United States in that regard. But importantly, it's not evenly spread across all sectors. Where is e-commerce having the biggest effect? Clothing, footwear, personal accessories is very big. Food retailing is quite small. Cafes, restaurants is quite small. Department stores having a lot of pressure from e-commerce. And as David Harrison said right at the beginning, one of the focuses in retail for Charter Hall is to look at those sectors which have a high exposure to non-discretionary expenditure, to those sectors where people have to go out and shop, where it's not so easy to buy stuff online. One of the trade-offs from the e-commerce, of course, has been the demand for industrial space. And this shows you the take-up in the industrial sector, which is where Charter Hall has about a quarter of its portfolio. In recent years, what you see is significant demand for retail space in terms of square meters, and significantly, a lot of that is transport logistics. Remember, here in Australia, Australia is a big place, and there are not many people. So when you get a container, offload a container in Melbourne, and you send it to Perth, when you open that container, there are not many people there to buy the stuff. It's not like Europe or the UK or even the United States. That means that logistics is critical, because your transport costs as a proportion of the population is much higher here than it is in almost any other developed country. So getting your logistics, the location right, the planning right, your inventory control right is critical. The rewards can be very high. The penalties for getting it wrong are likely to be very high as well. And finally, I just want to finish up with just leaving you with a couple of thoughts and a couple of calling these conundrums, because I don't think we know the answer to these things, but they're likely to be very important over the next few years. First of all, the question of valuation. David mentioned falling interest rates. This chart takes you back to 1985. The grey line is the 10-year bond rate. It was around about 14%. I don't know if any of you had the experience of buying a house in about 1986, 1987, as I did. I remember I was paying 17% on my mortgage, and I thought I was getting quite a good deal at that stage. Interest rates have been falling. That's the grey line. The pink line is the real interest rate. That's important for real estate. It's removing the effect of inflation. Real interest rates have also been falling. And the green line is the average office market yield. And that's also close to a historic low, but it hasn't fallen nearly as much. There's a big gap. You should remember what David said in his introductory remarks about the yield gap between interest rates and return on real estate. That gap is much wider than it was 10, 15 years ago. That's part of the reason why you're seeing a big shift of capital towards real estate. because the rewards look relatively attractive. But the question is, given that interest rates have been falling for 35 years, what's going to happen next? That 35 years is a long time. Looking around this room, I would reckon that most of us have spent most of our careers operating in markets where interest rates have been falling. That's been our story. That's been our career. Interest rates have been falling. It's been a bull market in bonds for 35 years. Hurdle rates have been falling. And the other side of the coin, of course, is that capital values have been rising. And anyone who's owned a house in Sydney for the last 30, 40 years would have had a pleasant experience of having an unexpected rise in capital values. That's been what's been happening for 35 years, and now it's probably stopped. So whatever your game plan has been for the last 30 or 40 years, maybe you should have a think about what's going to happen next. Nobody knows what's going to happen next, but the fact of the matter is that one of the big waves that have driven values and driven investment decisions has probably come to the end of its natural life. It's not just, of course, in bond markets, but it's also happening in real estate. And this chart shows you yields in some of the major real estate sectors. We talked about industrial. These are broad national averages, okay? So if you go back to 2008, that green line is average industrial yields. They were the highest, higher than neighbourhood shopping centres, the smaller shopping centres, and the red is prime offices. That was the industrial market in 2008. You can see what's happened to that green line. It's come right down. It's now challenging the office market. What you're looking at there is not just falling yields across the board, but you're seeing a significant re-rating. Suddenly, the industrial market looks a very different proposition. It used to be the cheapest sector. Now it's heading towards being perhaps the most expensive sector. You also, and it's perhaps a bit less obvious, but you'll also see that sub-regional shopping centres, which were quite a premium item 10 years ago, are now in fact at a discount to small neighbourhood shopping centres. Now again, I leave this as a conundrum. Are you looking at a permanent structural shift in the relativities of different market sectors, or is this just a part of the cycle that's going to reverse itself? It's important because it drives investment decisions. The second conundrum is the shift to real estate. I mentioned that there's a capital shift to real estate globally. This chart, which comes from a major global survey of $11 trillion of assets under management from 240 major global investors, shows the proportion of capital going to real estate. 2013, it was less than 9%, going up to 10.5%, and 2019, it's increasing. The global financial crisis has driven a major rotation away from equities and away from bonds towards real estate. And the real estate market is small. Because it's a small market, a small downweighting in equities implies a big upweighting in real estate. So the question then is, what happens next? As far as we can see, there's no diminution in that. As far as we can see, the weight of capital heading towards real estate is not diminishing. And from that point of view, it looks as if we're going to continue to see pressure on values, continue to see the growth in cross-border flows. Shall I leave it there? Are you waiting for me? That's okay. Okay, all right. I'll give you my last conundrum, and that is perhaps particularly relevant for this audience. Think about the Australian population. This chart shows you Australia's population by age. The number of people who are under 1 year old, about 300,000 Australians who are under 1 year old. And as you track there, the number of people who are 99 or 98, there are very few people who are 98, 99. This is the number of Australians in each age category. Okay? You've got the millennials, you've got Generation X. You'll see a bit of a spike here, that little blue spike there. That's the advance guard of the baby boomers. A large group of baby boomers heading up towards 68, 69, and 70. Okay? Now, looking at this audience and the demographics, I don't know if anyone owns up to being 33 years old. Anyone who's 33? Maybe in the IT department right at the back there. Anyone who's 33? Well, that's interesting because 33 is the most popular age in Australia. There are more 33-year-olds than any other age category. Okay? So that's the current profile. The green line is the forecast in 10 years' time. You can see that the baby boomers, that little spike, will have moved on. And one thing I can guarantee you, in 10 years' time, we'll all be 10 years older. Okay? So that spike will be down there. There'll be fewer baby boomers, but the ones who are around will be 10 years older. So the green line shows you what the profile will look like in 10 years' time. Now, look at age 38, 39. There's a big slump there at the moment. But in 10 years' time, there'll be lots of people who are 38, 39. Okay, there's a big growth there. There's a lot of growth here. We know this is the baby boomer aging population story. So a lot of growth in that sector. Look at 24, 25, 26. Just about no growth at all. Okay? So if you're in the business of providing services to 25 and 26-year-olds, you're in a low-growth market. If you're in the business of erecting apartments, one-bedroom apartments or studio apartments, where 25 and 26-year-olds can rent when they get their first job, the proposition is that there's not going to be much demand for those, or the growth in demand is going to be very low. But if you're in the business of providing service, what do people who are 36, 38-year-old buy? They tend to have one or two children. They're in the family formation age. They may be buying their second car. They start worrying about life insurance and all sorts of financial services. If they're living in an apartment, they want 2 or 3 bedrooms, not 1 bedroom. And they also want childcare, and they start thinking about education. Look at the education market. This is childcare, education. That's going to grow quite strongly as well. So the demographics is not entirely conclusive, but I think from this chart you start to at least get a checklist of sectors where you're likely to get a strong underlying demand. And we know it's going to be the aged population, it's going to be this group here, and maybe these are people who are looking to buy their first home or looking to live in a larger, different kind of apartment with concierge services and security and childcare and so on. And it's also in the social infrastructure, which is where Charter Hall has 10%, currently 10% of its portfolio. And I would predict that over the next few years, you're going to see that percentage increase because there's underlying demand for those kind of services. Thank you very much.
Thanks, David. Cheers. Thanks for that update on the market, David. And he's spot on there. Identifying the trends is a key part of what we need to do. The infrastructure piece is critical. A new train station near an office building improves amenity, means it's more convenient for your tenants. A new motorway near an industrial or logistics site shortens the travel time, the kilometres the cargo needs to travel, drives down costs, and equally makes it more important. For this part of today's presentation, I'm going to try and do 3 things, and I'll try and keep it brief. If I don't touch on something that you want more information on, please just come and ask me later. I will be hanging around after as well as the other team members. So I'm going to give you an update on our closed-end syndicates, where they're at, the unit prices, the returns, the vacancy, the occupancy. But I'm firstly going to run through our 4 open products, 5 if you include the new listed property securities, which we picked up as part of the Folkestone acquisition. And then I'm going to spend a little bit of time on 2 funds in particular, one closed and one open, the Direct Industrial Fund number 2 and the Direct Office Fund. And the reason why I'll spend a little bit more time on those is they have their major liquidity events coming up. So I want to explain to you the differences in how they operate and give you a feel for the kind of choices that you'll have as investors, many of you in those 2 funds. So the first fund I'll talk about is the PFA. It's a fund I'm very proud of what we've done here. We took over this portfolio and took over the management rights back in August 2012. At the time, it was a very diversified, and I'm using that word quite generously in this case. It had an eclectic mix of assets without a common strategy binding that fund together. We took 5 years to simplify that fund strategy, sell assets where we thought the value had either been maximised or that there was further downside risk. We lowered the gearing, which was approaching 60%, back towards the more 30 to 40% level, which we're comfortable with at Charter Hall. And in the last few years, we've successfully acquired additional assets, which are very much in line with the Charter Hall thematic of long-term leases, high occupancy rates, and fixed rental increases built in. And you can see here over the last 3 years, the funds have done a little under 12% per annum. The next open fund I'll talk about is the Direct Industrial Fund number 4. Creatively named 4 because it follows 3 other closed-end industrial funds. This fund will continue to grow. I want this fund to be like a large direct office fund. I think there are very strong reasons to having diversification and bigger portfolios in the current climate. You heard from David before, forecasting is very difficult. What I've learned from Cedric in particular early in my career, that it's inherently impossible. So what you can do is try and take as many of the known risks out of portfolios as you can, and not having exposure to a single asset or a single tenant can drop the risk profile of that particular investment. So what you do get in an industrial fund, which is a little bit different to the office assets, is you get longer term leases in place. You can see here a very well diversified fund, a little under 350 million. We've just signed a new asset down in Melbourne as of yesterday, which will push that portfolio value to around $370 million. It pays quarterly distributions, and it's really leveraging off that thematic with logistics and industrial being a growth sector, not just now, but into the future. I read an article in yesterday's paper, Blackstone, the largest owner of real assets, so property being a real asset in the world. They manage $720 billion of assets across the globe. They just bought a $25 billion industrial portfolio. And one of the senior leaders of that business is on record as saying, we believe logistics is a growth sector and it's our highest conviction thematic across the whole company. So that's what the big end of town are doing. That's what the very sophisticated investors are doing. And they're actually putting their large checkbooks where their money is, where their mouth is as well. Here is a short video of one of the most recent acquisitions by that fund, the Direct Industrial Fund number 4. It's located in Prestons in Sydney here. For those that don't know that market, it's Western Sydney, just off the motorway, fantastic location. Being close to that infrastructure is critical for industrial. The rent piece of the equation, typically for a tenant, does vary, is around 5% of their cost base. If you look at the logistical costs of unloading the goods, shipping the goods between the venues, that's 10 to 15%. So having the real estate located in the right locations is a much more important decision than the rent. So this is a new facility. I like new facilities, very low capital expenditure. And it benefits from having a high quality tenant in there, being Mainfreight, a logistics provider, and they signed up to a little bit over a 10-year lease, meaning I don't have to worry about downtime, I don't have to worry about vacancy, I don't have to worry about spending some, significant amounts of capex upgrading that property. And ultimately what that means is it gives me more certainty in the distributions that we can deliver to investors into that fund. Our fourth of the most recent unlisted funds is the Diversified Consumer Staples Funds. Some people have picked up that they thought it was heavily weighted to the retail market. What I would say is that we're repositioning that fund to focus on the healthcare market. We have 2 assets that are in due diligence at the moment in that healthcare space. You've just heard around the trends in what's going to happen in the demand for those services. It means that the users of that space will be particularly sticky because their businesses are forecast to continue to grow and continue to be strong. Means they can continue to pay the rent. And so over time, what you'll see is a larger proportion of this fund not only focus on that non-discretionary consumer staples element, but it will move and transition towards that healthcare market. And finally, the last open fund is the Charter Hall Maxim Property Securities Fund. We're very fortunate in that we picked this up as part of the bigger Folkestone acquisition. This is a liquid product. It invests in listed real estate stocks. I'm not an expert in that space, and nor is my team, but we have there an in-house capability now because we've got the whole team that was managing that, and that fund's been highly rated for a long period of time by external research houses. But something you should be aware of, whilst listed does provide that benefit of liquidity, and that can be a key driver for many investors, as opposed to the unlisted funds, which by their very nature are more like a term product where you should think of it as a 3 to 5 year investment term. Because it does invest in underlying stocks that are traded on the ASX, it does tend to have more volatility. And again, I just encourage you to think of all property, whether it's through a listed holding such as the Maxim Fund or the unlisted funds, you should be thinking about it around that 5 year investment term. In terms of the closed-end syndicates, so these are syndicates that we're still managing, but which are not open for new capital. What I would say here is that they've continued to do what they said they would. High occupancy, in fact, they're all 100% occupied. Long-term leases in place. The shortest there is leased to Coles Adelaide at 7.9 years. We are liaising with Coles to try and extend those leases out, not just for this asset, but another Coles asset in Perth and one in Melbourne. We're very fortunate that we've got a very strong relationship with Coles. We're actually their #1 landlord in the whole of Australia. And that's because we have them in not only our industrial properties where they have distribution centres, but your more traditional retail centres, and we have their head office in Melbourne as well. The other two types of investments, the BW Trust, we recently extended the leases by 5 years, a good example of active management. So not sitting there saying the lease terms are now 7 years, that's pretty good, plenty of time, we can sell that on and give investors their money back. What we did was we actively negotiated to extend those leases back out with Bunnings, and we simply put to investors, what would you like to do? You can continue in that fund, or if you'd like to redeem, we've got plenty of investors that would like to acquire units, and that fund has rolled for another 5 year term. And the Direct Automotive Trusts, who have as their key anchor tenant, AHG, Automotive Holdings Group. For those that are across the financial press, they're subject to a takeover offer by AP Eagers. What I would say is from a landlord's point of view, that's fantastic. You hear me talk a lot about income security. That's what I know many of you have invested in these funds for. Secure income streams that pay out capital to you, the income to you over monthly and quarterly periods, and which will grow over time. So I'm looking at AHG, and they've got a market capitalisation as of yesterday of $930 million. AP Eggers have a market capitalisation of a little shy of $1.95 billion. So put them together, my covenant strength has just improved, meaning that that business is even better positioned to continue to pay those rents for the long term. Equally, through the industrial team and Richard, we've got very good insights into those both tenants. And so we're already engaging with them to understand what their property needs are into the future. Again, trying to understand whether we should sell assets early, should we extend leases, and make sure that we're developing a strategy that suits the tenants and ultimately delivers the investors the best returns. The other industrial funds, I've already talked about Div 4, so I won't touch on that anymore. But the Direct Industrial Fund number 2, I will spend a few minutes on shortly, and that's because it does have its liquidity event coming up. And the Direct Industrial Fund number 3 still has a number of years left to go, and that's doing exactly what it said it would do, continue to grow distributions for investors. I've had a number of investors ask me what's happening with distributions going forward. Unfortunately, it's a little bit too early in the year for me to give that information out. What I would say is the team are going through a detailed process of building up property by property to the fund level. The team are pulling that together, and ultimately I'll need to make a recommendation to my responsible entity board. But for the majority of funds, what I would say is that the income and distribution rate is expected to increase from 1 July onwards. So Div 2. When we first launched this, there was just 2 assets in the fund. Investors trusted us as a manager that we would deliver on the investment mandate, that we would only acquire assets that we said we would, and I'm very pleased to say we've done that. Even though this fund has been running for almost 6.5 years, the weighted average lease expiry is still over 10 years. So it gives you an idea of not only the length of leases you can get from industrial and logistics, but combine it with the active management that Charter Hall does, where we engage with tenants, we engage with them early, and we try and continue to extend the lease terms out well in advance of those expiries. So what did we actually do in a bit more detail when we did Div 2? Well, as I said, we built out that portfolio to $288 million now. 3% fixed rental increases average across that portfolio, meaning that the distribution rate has grown over time. We diversified the portfolio and we actually focused heavily on the Eastern Seaboard. We saw that that was the market where we thought had the best growth opportunities at that time, particularly relative to the price that we could acquire those assets. So the risk-adjusted returns look great, and that's what we delivered in terms of where we put the money. We actively manage the portfolio. So I just said we try and extend leases. And so what we did here is we had a situation where the key tenant at 2 assets, when I say key, it's probably an understatement, the sole tenant at 2 assets actually went into insolvency. So Arium, everyone saw the headlines, the big steel group blew up. Not because of the use that they were using in these sites, but largely because of the Whyalla steel mill, which was a big albatross around their neck, which was dragging the whole group down. So what we did was we actively engaged first with the liquidators and the administrators, and then quickly transitioned that to the Gupta Group, who were the front runner to acquire that business. What it meant was ultimately we extended the leases at both sites by 5 years, so 5-year lease extensions, but that's no good if your tenant's not going to be around. We dug through all the financials of the acquiring entities and we extracted some bank guarantees as well. So we understand that we're the only property group who managed to negotiate those bank guarantees with that incoming tenant. To everyone else, they just said, no, take it or leave it. And yet we were able to get a more secure position for our investors through that process. We actively manage the portfolio. So at Charter Hall, we're not an accumulator of assets. If we think an asset value has peaked or that there's nothing else we can do, we're happy to sell it. We had, last time I was up here last year, we talked about the Toll Rockhampton asset. We thought that was probably as good as it was going to get for that particular asset in that location. We sold that at a premium to book value and we returned the money to investors. Ultimately, if we give a good return, we would still rather give the money back to you and you can make the decision on where you want to put it. And that's a key point because that cuts not across just Div 2, but the rest of the portfolios that we manage as well. So what we're looking to do for Div 2's review event, and I want to compare and contrast this to what I'll be saying shortly on the direct office fund. So this fund was set up as a fixed life fund. So at a particular time, it would end. That's very different to the 4 open funds, or 5 if you count Maxim, that I talked about earlier. What they have is rolling 5-year events. So every 5 years, investors are provided the ability to get their equity back. With this fund, it was set up as fixed life. What the PDS did say was that we could extend it or make a recommendation to investors to extend it for 3 years if we thought it relevant to do so. And having now had the opportunity through myself, Ross, Scott, our investor relations team, Marco, we spoke to many investors who have said, Stephen, this fund still has a 10-year whale, it's fully occupied, and it's doing what we say it would do, which is providing that long-term income stream. So we don't want to sell. So we're going to give investors the ability to choose what they want to do. We'll simply write to you, and if people want to exit, that's fine. We'll be able to source replacement equity for that. The ongoing distribution yields around 7%. So again, very attractive, particularly in a low-yield environment, which we operate. But in the event that we did get more than 50% that want to redeem, we would look to wind up that fund or find a buyer for all the units. What I would say is we've been through many events like this historically, and typically the amount of people that want to redeem from the strongly performing fund is around that 15 to 20% level. So that's what I'm expecting. If you're in that fund, the expectation is that it will continue on for another 3 years, but of course it is subject to what ultimately investors tell us they want to do. And you can see here graphically, I'm a very visual person. I like to see things in graphs and charts. You can see here the income and distributions have grown over the term of the investment, even though we sold a property. So we sold a property, we're getting less income, we've returned that capital to investors, and yet we still managed to grow the income stream, primarily because of those fixed rental increases which come through. You can see here a drop in the unit price. It's not a drop in the traditional sense, it's simply because when we sold that asset, we gave the money back to the investors. And that's how we show it. We used to show it grossed up, but then people would get confused saying, well, Stephen, it's actually not $1.34. You tell me it's $1.26. Here's another short video, not because I'm being a lazy presenter, but because you heard earlier, real estate is a tangible asset. And one of the key advantages is you can see what's happening at our sites. Last time I showed you some external footage from the outside of this Woolworths distribution shed. It's a 20-year lease to Woolworths, $200 million we paid as a group, Charter Hall. Woolworths has spent over $300 million internally on the automation there. So what I would say is here, even though that you see lots of people in this video, this is a Woolworths produced video, I suspect that's not an accident. Because of all the automation, the amount of people that they actually need to run that site is significantly down on what it used to be. So you'll see here the conveyor belts, the internals. Really, people don't need to touch the goods in that shed except to unload it off the first truck that drops it off and reload it. There's autonomous robots throughout that property, and the only picking that they do is for unusually shaped objects. And which brings me to our last fund, which I'll talk about, the Direct Office Fund. It's probably our flagship fund, not just because it's the largest, but because it's been around for the longest. It's now over $2 billion. It jointly owns assets with many of our wholesale vehicles, has a long-term lease structure, particularly for an office fund, at 8.6 years, and it also has its review event. So this fund, being an open-ended fund, has its liquidity event in December, but this fund will definitely continue. So it just happens every 5 years. This will be our third liquidity event we've managed for this fund. We know what to expect. We've positioned assets for sale, which we want to move on. We're running a very low gearing strategy of this fund to make sure there's capital there. And we're also talking to new equity investors who want to get into the fund. So this is very simple here, what we do. We simply write to investors and we ask you what you want to do for your individual holding. And it goes from everything, whether you want to stay invested for another 5 years, your choice. If you want to partially redeem some holdings, again, that's your choice. Or if you want to redeem the full amount, that's absolutely fine as well, because ultimately we want investors in our funds that want to be there for the long term. And again, there's not much more to say on this other than you can see here the same sort of story with the Indirect Industrial Fund. Distributions increasing over time and the share price as well. And look, I'm running a little bit out of time. We're running a little bit behind today. So look, I could talk about this fund and all our funds all afternoon. There will be questions inevitably, particularly if you're in DOF and DIF 2 around the review event. I do encourage you to ask any of the team members that you see here. We will make ourselves very available. And finally, before I open up for a short period of Q&A, what I would say is this is a good example of the kind of assets which we've bought in the last 12 months across our suite of funds. A 10-year lease government property, the first one there, owned by DOF in Brisbane. We like the Brisbane thematic. We like the risk-adjusted returns. We like the fact you can buy this at a 6% cap rate instead of a high 4%, which you would if it was in Sydney or Melbourne. The Main Freight large distribution centre, which was the video I showed you earlier, acquired by DIF 4. And more recently, the 10 Shelley Street down at Barangaroo, one of the few freehold properties in that precinct, benefits from a long-term lease to a high-quality tenant covenant in Suncorp. So look, that is a quick run through. By definition, it needs to be pretty quick. We've got 10 funds to try and get through in a very short period of time. And as I said at the start of today's presentation, the aim here isn't to promote our products. The aim is to educate you as investors. We want you to know where the markets are, what the trends are. And so look, I will throw it open and I will invite our two guest speakers just to the stage. Is there any online questions? Okay. Do you see space optimization technology driving reduced office space demand? Well, I'm going to pass that straight through to you, Selena. That seems right up your alley.
Yes, look, it's interesting. Without a doubt, the space demand is compressing. If I again just take EY as an example, we know that over the last several years, we grew our employee numbers by 25%, whilst at the same time we moved, this is in Sydney, from 680 George Street down to 200 George Street, and we managed to compress down about 50%. So we are working in, as I sort of said, we've gone from offices to everyone just having open plan hot desk situation. So I do see that compressing, though what I think we're seeing is also different types of space. So people that may have traditionally just worked from home or worked in non-traditional formats actually coming in and using space in the likes of sort of WeWork or co-working locations. So I think whilst we're seeing space compressing by some of the large employers, there are freelance and gig style workers that may not have worked in offices before that are now starting to come and work in some of those spaces. The technology point's a really interesting one. It's still emerging, I would say. We do some work on that ourselves, and we're still trying to find that holy grail of getting the technology that really genuinely, accurately assesses that. I think we could see some further compression as that technology gets better.
Thank you. David, I'll throw the next one to you, which is what do you think the long-term impact will be on retail property with a trend of online purchasing continuing?
I think your first impact is really on tenancy mix. I think there's no doubt that you're going to see strong growth in certain types of retailing, probably weaker growth or even contraction in other types of retailing. I wouldn't underestimate the capability and the capacity of shopping centre managers and retailers to adapt and adopt. And given that we are sort of 5 or 10 years behind the United States, for example, and a lot of other countries, I think there's a lot that we can learn from a retailing perspective in terms of what you can do to deal with the impact of IT. I think we're seeing retailers here, for example, the department stores, putting significant investment in getting their own websites organised, so that it's not going to be an either/or. Either you're an IT retailer or you're a physical retailer. I think you're going to see a lot more retailers deal in both spaces, and we are seeing some IT online retailers looking to find physical space, because people do actually want to see what they're buying before they get it, especially for significant items. So I think it's a flexible position. I think there's no doubt that the retail sector is going to have to change quite significantly, and I think you'll see some relative values change between different kinds of retailers. Right now, even if you take, for example, the regional sector or the neighbourhood sector, the difference between weak centres and strong centres is very significant. There's a wide range within each format between the sectors that are doing well for demographic reasons, for tenancy mix reasons, for property management reasons, and the centres that are doing badly. So I'm sorry, it's a rather imprecise answer, but I think you really got to take advantage of the changing scenarios which are emerging. But I'm pretty confident that you'll see significant responses from the retailers themselves.
The next question I'll take myself, which is, will you be launching any new open or closed-ended funds? The short answer is no, nothing is planned. And I'd say that for mainly one reason. I think that the bigger diversified funds have a number of scale benefits over launching a new fund at the moment. And it doesn't mean we won't ever do a new one. It just means that between two office funds, an industrial-focused fund, a portfolio weighted towards consumer staples, and now a listed property securities fund, we think we've got most of the key sectors covered, and that larger funds benefit from having had the ability to amortise the cost of stamp duty already over a long period of time. You get scale benefits because your cost of debt is cheaper when negotiating with the banks. They see the bigger funds as lower risk. And you also get scale benefits in terms of providing liquidity. It's much easier to sell off one or two assets than it is provide any liquidity if you've got a one or two asset syndicate. So that's the answer. Never say never, but it's a question I get asked a lot, but there is nothing imminently in the wings. So look, with that, I might finish up today. I'd like to, again, thank our speakers for spending their time. I know they're both extremely busy, so please just give them another round of applause. Thank you. Thank you. And now I will introduce a new speaker to close this year's event rather than Cedric. I'd welcome to the stage Ross Victor, who's head of the distribution for Charter Hall Group, has over 36 years' experience in the financial services industry in Australia and New Zealand, including distribution management, development of financial advisors, and implementation of strategic projects. Please welcome to the stage Ross Victor for a few concluding words. Thank you.
Well, thanks very much, Steve, and most importantly, thank you to you. What a wonderful lunch. Have you enjoyed it? Great. I guess today we've had almost 160 people join us for lunch, and that's no mean feat. It's a credit to all the team. And when you look around the room, a number of you have actually been with us for a number of years. It's a pleasure to actually have Cedric with us and also Richard Stackett. Cedric's obviously keeping a watchful eye on us as we go through post his retirement period. I guess today was about sharing with you some exclusive insights into the market, and we've been joined by both David and Selena in providing that. David touched on the health theme when we're up in Brisbane, and I know tonight is State of Origin for you who follow the game. I mentioned when I welcomed the chap up there, how he was, and he responded to me, Ross, it's no longer a question of staying healthy, it's now a question of finding an illness that you like. So for some of you out there, the health sector is certainly something to focus on. David Harrison in his address highlighted for us a business that's grown dramatically to $28.5 billion, around about 820 assets. And like all investors across the Charter Hall suite, you as self-managed super funds and direct investors really are attracted to the yield and steady growth in the income that the actual underlying funds have provided. Today we've had an opportunity to share and learn from a number of highly qualified people who are experts in their traditional fields. And when David touched on just simply the growth in the fund, he really did not address the growth that's actually happened within the organisation. I'm really reminded that a quote by Robert Schuller, who basically said that today's accomplishments were yesterday's impossibilities. For those of you who are unaware, the actual organisation has been involved in $31.3 billion worth of acquisitions over the past 5 years. We've had growth in the organisation of around about $17.8 billion, and David's been at the forefront of that transactional history. $9.3 billion worth of investments, and Richard, who now heads up the industrial team, has seen significant growth in that logistics market. We're privileged to have Selena with us to hear about I guess the trends, the mega trends, the innovations, driving the direction of property more broadly and the future. A couple of key points that I took out of Selena's. Well, I can still remember as an old bloke actually knowing more than what my phone does now. And I guess artificial intelligence is here to stay, but it's no match for natural stupidity. David Rees from Jones Lang LaSalle gave us some fantastic insights into the market. And I can tell you that nothing is as frustrating as arguing with someone who knows what he's talking about. And I guess at a lunch like this, I'm always amazed at the statistics that David and other people can bring to us. When I was sitting there, I was just sort of thinking through, out of the 160 people, roughly 50% of us have actually ordered the same thing from the menu. Finally, we had Steve update us on the Charter Hall Direct suite of funds and a couple of key case studies. That Woolworths distribution facility video, really just a fantastic video. I've seen that now a dozen or more times. Just to give you some background to that, there's 14 kilometres of high-speed conveyor belts in that building, 50 robots, 13 cranes, and Australia's largest rooftop solar installation. Ladies and gentlemen, our sincere thanks for your attendance today. We believe that events like this luncheon provide us with a special chance to meet with you and acknowledge the ongoing support and participation in the Charter Hall funds. Moreover, we wish to produce an event and an experience that ensures that you feel you've gained more in-depth knowledge and feel that we're committed to deliver upon your expectations. I'd like to actually thank Amy and Lucy for their wonderful organisation of today's event, and Craig and Taylor for their efforts with you over the past 12 months and their interactions. Thank you, ladies and gentlemen. We look forward to having you again next year. Thank you and good afternoon.